Did you know that 78% of Americans live paycheck to paycheck? And almost half of them couldn't cover a $400 emergency without borrowing money or selling something. That's a shocking reality for many people. But what if I told you there's a way out? What if I told you you could build wealth without needing to be a genius or starting with a huge amount of money? The best book I've ever read about financial freedom revealed something amazing. You don't have to chase get-rich-quick schemes or work yourself to the bone. Instead, you can build long-term wealth by investing smartly, using a strategy called value investing. It's not about buying the hottest stock or following trends, it's about finding undervalued companies and letting time do the heavy lifting. In this video, we're diving into the powerful strategies from this book that can help you escape the paycheck-to-paycheck trap. Whether you're new to investing or just want to refine your strategy, I've got some simple, actionable tips that can change your financial future. Ready to unlock the secrets of smart investing? Let's go! Chapter 1. Unlocking the Vault. The hidden secrets to building wealth through value investing. Value investing isn't just about picking cheap stocks, it's about finding real value. The best book I've ever read about financial freedom taught me that great investments aren't always the most obvious ones. Instead, you have to look deeper, past the surface. It's like finding hidden treasure. Warren Buffett, a master of value investing, once said, "Price is what you pay. Value is what you get." This sums up the entire strategy. Investing in undervalued companies is not about jumping on trends but about finding long-term value. One of the first strategies the book highlights is the importance of understanding the company's intrinsic value. This is the actual worth of a company based on its fundamentals, not its stock price. For example, Apple may look expensive at $150 per share, but when you calculate its actual value based on its earnings, growth, and market position, it could be worth much more. The book urges you to think long-term and avoid short-term market noise. This doesn't mean ignoring the market. It means understanding why a company is undervalued. Did the stock drop because of market panic? Or did it fall because the company fundamentally changed? Recognizing the difference is crucial. Investors who focus on the value of the business rather than its market price are often the ones who see substantial returns. This approach also helps in avoiding the herd mentality, which can lead to poor decisions. A unique strategy from the book is focusing on margin of safety. This means buying a stock at a price well below its intrinsic value to protect yourself from downside risk. Think of it like buying a house below market value with plenty of room for appreciation. The larger the margin of safety, the better protected you are from market dips. Chapter 2. The Secret Sauce. Why patience is your greatest investment strategy. If there's one thing this book made clear, it's that patience is essential. In fact, one of the strongest messages was, slow and steady wins the race. Value investing isn't about fast results, it's about waiting for your investments to grow over time. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. The book stresses that successful investors don't panic during market downturns. Instead, they stay the course and trust that their investments will pay off. Studies show that the average investor holds stocks for only about 5.5 years, while the average successful value investor holds theirs for much longer. This patience results in compounded returns over time, a key to financial freedom. Take Coca-Cola, for example. Investors who held onto Coca-Cola for decades saw their investment grow exponentially. The book discusses how value investors have been able to ride out market crashes and economic downturns by sticking to businesses they trust. In fact, one study from the University of Chicago showed that the top 10% of investors earned more than 2,000% in returns by being patient and sticking to their investment strategy. The key here is understanding that volatility doesn't mean the business is bad. It means it might be a great time to buy. By waiting for the right opportunities and buying at a discount, you set yourself up for financial freedom. The book shares countless examples of investors who doubled, tripled, or even quadrupled their money by not rushing to sell during turbulent times. Another tactic that makes patience a powerful tool is the concept of reinvesting dividends. The book shares how many of the wealthiest investors today made their fortune by reinvesting their dividends and compounding their returns. Over time, this strategy can lead to exponential growth, even from a modest initial investment. Chapter 3. Hacking your financial mindset. Shifting from a consumer to an investor. The biggest shift that happened when reading this book wasn't about stocks or numbers, it was about mindset. It opened my eyes to the fact that true financial freedom starts with how you think about money. The book teaches you to see yourself as an investor, not just a consumer. Think about this. You don't have to be rich to invest, but you do have to start thinking like an investor to become wealthy. A major part of this transformation is understanding the difference between assets and liabilities. An asset puts money in your pocket, while a liability takes money out. Most people live their lives accumulating liabilities, things that cost them money, like expensive cars, flashy clothes, and luxury vacations. But financially free people focus on acquiring assets, like stocks, real estate, and other investments that generate income. In value investing, this mindset shift is especially crucial. You're not looking to buy stocks that look flashy or trendy. You're looking for businesses that are undervalued and can grow over time. The book encourages you to think critically about where you place your money. The author quotes Ben Graham, who said, "The investor's chief problem, and even his worst enemy, is likely to be himself." The book also emphasizes the power of financial literacy. Once you understand how markets work, how to evaluate businesses, and how to think like an investor, you can make smarter decisions. This shift in mindset is the cornerstone of financial freedom. If you invest just 10% of your income, over time, that 10% will start working for you, not the other way around. A surprising fact shared in the book is that the average millionaire is a self-made investor, not someone who inherited their wealth. In fact, a 2020 study by Fidelity found that more than 80% of millionaires made their fortune through consistent investments, not by making huge one-time bets. The book drives home this point by showing how many of the world's wealthiest people built their wealth gradually by investing wisely and sticking to their strategy. Shifting your mindset isn't just about investing money, it's about investing your time and knowledge. The book shows how successful investors spend time reading, learning, and staying up to date on financial markets. This constant learning process compounds just like the returns on your investments. If you're finding this helpful, don't forget to subscribe to stay updated on more tips and strategies for financial freedom. Chapter 4. The 10x Rule. How Value Investing Beats Get-Rich-Quick Schemes. If there's one thing that the best book I've ever read taught me, it's that value investing is the opposite of get-rich-quick schemes. Instead of looking for instant returns, you focus on long-term growth. And while it might sound boring, this strategy has proven to be far more successful. The book argues that focusing on sustainable growth, rather than chasing short-term gains, is the key to lasting wealth. You see, the idea behind value investing is that by buying undervalued stocks, you're setting yourself up for 10x or even 100x returns over time. That's much better than trying to make a quick buck by speculating on risky investments. The book shares a quote from legendary investor Philip Fisher. "The stock market is filled with individuals who know the price of everything, but the value of nothing. One of the major strategies is focusing on companies with a competitive edge, or economic moat. The wider the moat, the harder it is for competitors to take market share." Think about brands like Coca-Cola or Amazon. Their brand recognition and customer loyalty make them incredibly difficult to replace. By identifying companies with solid moats, you're increasing the chances of holding onto a stock for years, while it steadily grows in value. In fact, research supports this strategy. According to a study by Morningstar, companies with wide economic moats outperform the market by 5% annually. And while this doesn't sound like much at first glance, over decades, it compounds into massive wealth. The book emphasizes the importance of not just buying stocks, but buying the right stocks, ones that will stand the test of time and rise significantly in value over time. One of the most powerful lessons in the book is learning to resist the temptation of speculative investing. Sure, it's tempting to chase the latest hot stock, but that strategy rarely works out. According to data from Dalbar, a financial research firm, the average investor earned just 2.5% annually over the past 20 years, compared to the S&P 500's 9.9% return. This gap shows just how disastrous it can be to jump in and out of stocks based on trends. In contrast, value investors take a different approach. Instead of following the crowd, they dig deep into a company's fundamentals. If the stock is undervalued, they buy, and if it's overvalued, they wait. This approach takes time and discipline, but over the long haul, it can deliver impressive returns. Chapter 5. Finding Hidden Gems. How to spot undervalued stocks like a pro. One of the most exciting parts of value investing is discovering those hidden gems, the stocks that are undervalued by the market but have great potential. The book shares a powerful strategy for spotting these opportunities. Focus on businesses that have a solid track record of earnings growth and are currently underpriced. It's not about finding stocks with flashy headlines, but those with real, consistent value. A unique concept from the book is looking for catalysts that could trigger a company's growth. These catalysts could be new leadership, a new product launch, or a change in market conditions. For instance, in 2019, when the book was published, Tesla was considered overvalued by many, but investors who dug deeper realized that its shift to electric vehicles would drive long-term growth. Those who saw this early on earned massive returns. Another tip for finding hidden gems is understanding the concept of value traps. These are stocks that appear cheap but are cheap for a reason. The book explains how important it is to dig into a company's financials to ensure that a low price isn't a sign of deeper problems. For example, a company with high debt and low cash flow might seem cheap but could be on the verge of bankruptcy. The book also talks about the importance of industry analysis. It's not just about finding undervalued companies, it's about finding undervalued companies in industries that are poised to grow. For instance, sectors like renewable energy, technology, and healthcare have shown significant growth over the past decade, while others like print media have been in decline. A key factor in finding these undervalued companies is analyzing their financial statements. The book teaches you to look at the price-to-earnings (P/E) ratio, price-to-book (P/B) ratio, and return on equity (ROE) to gauge whether a company is truly undervalued. A P/E ratio below the industry average could indicate that the company is undervalued, but it's essential to confirm that the company is in good financial health. Once you've found a potential gem, the next step is to perform due diligence. The book explains how some investors skip this crucial step and end up losing money. You need to look beyond the headlines and dive into the company's history, leadership, competitive advantage, and future prospects. This is the true art of finding undervalued stocks. Chapter 6. The Power of Simplicity. How a clear investment strategy sets you free. The best part about value investing is that it's simple to understand. The book emphasizes that complexity is often a distraction, and the simplest strategies are often the most effective. By focusing on a clear investment strategy, you can avoid emotional decisions and stay disciplined in your approach. One of the most powerful aspects of value investing is how it sets you free. When you follow a proven strategy, you don't have to constantly worry about the market's ups and downs. This book teaches you that the best investors are those who stick to their principles and remain patient, even when others are panicking. A key lesson in this chapter is the importance of creating an investment plan and sticking to it. The book shows how successful investors often avoid the temptation of short-term gains by adhering to a strategy based on fundamentals. They don't chase after the next big thing. They trust their research and let their investments grow over time. This strategy also involves understanding your own risk tolerance. The book encourages you to be honest with yourself about the level of risk you're comfortable taking. Knowing this helps you avoid making impulsive decisions during market volatility. When you have a clear strategy, it's easier to stay calm when the market fluctuates. The book also shares a unique point: the power of diversification. Many investors think they need to pick individual stocks to succeed, but the book stresses that having a diversified portfolio is essential. By spreading your investments across different sectors and asset classes, you protect yourself from unexpected market shifts. Perhaps the most important point from the book is that financial freedom doesn't happen overnight. It's the result of consistent effort, discipline, and sticking to a clear plan. The wealthiest investors didn't get there by chasing the latest trend. They got there by following simple, time-tested strategies. Thanks for sticking with me. Make sure to subscribe for more practical strategies and tips on how you can achieve financial freedom through value investing.